Hey guys, this is Fernando Angelucci from Self Storage Syndicated Equities. If you want to learn more on how to use your small axe to build an empire, you should be listening to the Small Axe podcast with my good friend, Nico.
Hey, guys, this is your boy Nico, your host of the Small Axe Podcast. Hey, this show is dedicated to helping you become the best multifamily real estate investor that you can be. Now, whether you want to be an active or a passive investor, this show will give you all the resources you need to help sharpen your axe and build your own personal empire. So you know what? Sit back and relax and enjoy this show. And hey, if you find value in it, I would love for you to subscribe, leave a 5-star rating, and write a review. I love you guys.
Okay, Small Axe community, it is your boy Nico here, and I'm back, and I'm hanging out with a dude named Fernando Angelucci. And Fernando and I met via the internet, as many of us do these days. You know, I look for people to come on my podcast, and he was one of the people that decided to jump on my podcast. And I don't know him very well, so I'm really excited to get to know him because I know what he does, and it's really cool. So, Fernando, welcome to the show.
Thanks for having me, Nico. Appreciate it.
Yeah, I'm excited to have you and talk because I've only had a couple of people in the self-storage business come on this show, and it's really interesting, really, cool what you guys are doing. So I'd love to learn more. But before we get there, can you kind of take a minute or two to just share a little bit more about your background and how you got to where you are today?
Yeah, so I started when I was 16. I read Rich Dad, Poor Dad, and that kind of changed the trajectory of my life. Still went to school and got an engineering degree like my parents wanted me to do, kind of old school American dream. But then immediately within 13 months, quit my Fortune 50 job, started in the single family and small multifamily realm, built up that company until we had a reasonable size portfolio. And then me being an engineer, being very risk conscious, very risk averse, I thought the market was starting to crash or was going to crash in 2018. So in 2016, I started to sell off my portfolio, sold my last couple of multifamily buildings in 2018, and then jumped into self-storage as the next asset class that I was going to conquer. So bought my first self-storage facility in August of 2018. And here we are in March of 2023. We just crossed over 220 million in self-storage. I have another about 140 million in self-storage developments in the pipeline for this year so far.
Wow, man. Congratulations. That's awesome.
Yeah.
And so why self-storage?
So I saw this increasing trend in kind of the political sphere in the United States of, the government trying to insert themselves into, private business. So, perfect example was the pandemic or COVID. They told basically tenants, in other words, that they didn't have to pay their rent and that nothing bad would come if they did that. But at the same time, they didn't say, hey, landlords, you can stop paying your property taxes or you can stop paying your mortgage. And I think that was an overreach on the government's part to just allow like a blanket policy like that. It should have been approached a lot more carefully and systematically. And because of that, I have a lot of friends that lost a lot of value, lost a lot of properties because of that time. And so I've been seeing this trend continue for the last 10 years. It starts in New York, it starts in LA, and then it kind of makes its way inward. San Francisco is another one that's on the leading edge of this. Rent controls, requirements for, certain types of housing, or else you don't get zoning or whatever changes you needed. So I wanted to go into an industry where there was basically no habitation. So non-habitation based real estate. I didn't want people living in my assets. Another reason why we switched from multifamily into self-storage was because multifamily, you're guided by the, landlord renter laws or eviction laws, whereas with self-storage, it's property law or lien law. So the second you put your possessions in one of my units, I automatically have a de facto lien against your possessions. And if you don't pay, I can lock you out of your unit within 5 days of a missed payment. And within 45 days of a missed payment, I can already auction off your possessions in order to recoup any lost rent. That's a much faster turnaround time on a delinquent tenant than, say, what I was experiencing. I'm from Chicago. I invested in some more challenging areas of Chicago, and there were a lot of, I would call them professional tenants, where they really knew all the little nuances and ways to extend eviction maliciously, not because they needed to, it's just because they knew how to game the system. So, there was times where I did everything in the correct legal order, correct legal fashion, and the soonest I'd be able to be seen in front of a judge to get that eviction order was 8 months or 9 months. That's a huge amount of not only missed revenue, but in addition to that, usually the tenants, before they left, they would destroy the apartment, and then I'd have to go after them in small claims court, or if it was a larger damage, a full blown lawsuit. And a lot of the times these tenants didn't have the money to pay for the several tens of thousands of dollars of damage that they caused to my assets. I mean, it was getting out of hand. So that's when I decided, I need to get into an asset where I control more of the revenue, and it's not up to kind of third party factors and jurisdictions and laws to kind of get in the way.
Really interesting, Fernando. I didn't really know that much or that many details about self-storage. I'm actually pretty ignorant to it. So I'm really excited that we're talking about it, because it is something that has been on my radar for a while, to at least learn a little bit more. And I was reaching out to people recently there were two people on my podcast who for self-storage in particular. And I was looking for like an underwriting tool and an analyzer to start looking at some things. And it was tough to find one. And that's kind of a little side story. So now, it's going from dealing with people to dealing with people's stuff could be a lot less complicating, right? Or at least it seems less intimidating and a little bit more owner friendly. But are returns good? Are returns similar in the self-storage space?
Yeah, absolutely. And so just to kind of go back on one of your comments, you said, if you need an analyzer, I can send one over to you. We have a really great Excel sheet that you can plug and play. So I'll send one of those over. I'm making a note here now. But yeah, the returns are fantastic. So I actually have a ton of data on this. I'm a data-driven guy, engineer by training. So let's look at a study period from the National Association of Real Estate Investment Trusts that was started in 1994 until present. During that time, the S&P 500 on average returned between 7 and 8%. Multifamily did almost double that, returning about 13% on an average annual return basis. Self-storage returned to 17.4%. So, an extra 4.5% over multifamily. Now, people are saying, okay, 4%, that's not a lot, but you got to realize this is 4% compounding. So if in the beginning of that study period, you had $100,000 to invest, if you put that 100K into S&P 500, you'd have a little over $500,000. If you put them into the apartment space, you'd have about 1.8 million bucks. So really good return over the S&P 500. But if you put that $100,000 into self-storage, you'd have a little over $4.1 million today. So much higher growth. And the interesting thing is people typically say, well, if it's high return, it also must be high risk. And the data actually says that that's not the case. So if you look at self-storage, it actually has asymmetric risk return profiles. So let's look at, let's say 2007 to 2009, the great financial crisis, when, there was a lot of shakeup in the market, liquidity basically dried up. During that time, the S&P 500 dropped 22% in value. So if you were, your typical 401k investor, it took you almost 10 to 15 years to get back the value that you lost in that 2 to 3 year period of time. Now, if you look at multifamily, on the other hand, it did a little bit better than the S&P 500. It lost about 7% in value. Self-storage lost about 3.5% in value. So the risk profile was lower than those other two, even though the returns were much higher than the other two. Now, that 15 plus years ago, let's talk about something that's a little bit more near and dear to our heart, which I already touched on, which was the COVID pandemic, right? So TREP, which is a commercial mortgage-backed securities research firm, did a study that of the 1,700 CMBS loans, commercial mortgage-backed security loans, that were made to self-storage investors in the first 3 quarters of the pandemic, only 3 of them were more than 30 days delinquent. That is a 0.17% delinquency rate. Now, during that same time, multifamily, through the CMBS market was defaulting 1,800% higher, 18 times the default rate of self-storage. So when I look at the data, this is one of those industries where I say it makes sense to go into, especially when I'm projecting that we're going to go into a pretty tough 1 to 2 years ahead of us now with, some pretty tough recessions. If you look at household savings rates, they're the lowest that they've ever been since the great financial crisis. If you look at household debt and corporate debt rates, they're at the highest they've ever been since the 2008 financial crisis. And then when you look at subprime defaults on things like car loans and student loans, they're at the highest that they've ever been in general. So, I can go further into detail into this if you'd like, but, if you look at bank loss data from Wells Fargo Securities and Intex Solutions, they also show that self-storage has the lowest default rate of any asset class over the last 20 years. And then in the rare case of a default, they also had the lowest amount of value lost in that default compared to any other asset class in the last 20 years or so.
Fernando, really cool, really interesting stuff. To kind of continue with this conversation, who are you buying your self-storage properties from? Like, are these institutional owners, or are they mom and pop? Are they all the above? And who are you competing against? I know the multifamily space is extremely competitive. Is it as competitive?
Nico, this is a absolutely fantastic question. So self-storage is where the multifamily space was about 30 years ago today. So what do I mean by that? Self-storage is an extremely fragmented market. So there was a study done in 2017. There's some unofficial numbers that were updated. So there are roughly between 50 and 70,000 self-storage facilities in the United States. The breakdown of that industry ownership is as follows. Roughly 20% are owned by the 6 largest publicly traded REITs. The next 9 to 10% are owned by the next top 100 largest operators. And I'm in that group of operators. That means that there is over 70% of the market is owned by mom and pop operators. And I'm using air quotes for the listeners out there not watching the video. That a mom and pop operator is someone that owns 2 or fewer facilities. So we have 3 main strategies when it comes to our acquisition pipeline. Where we started and what has the lowest risk is buying existing cash flowing assets from mom and pop investors. The reason we like this strategy is because we're able to buy deals that debt cover right off the bat. They have the ability to increase rents. They have the ability to drop expenses, just like how you do with multifamily properties from mom and pop operators, right? These are seller profiles, typically someone that is, 65 years or older. This is their second or third time that they're considering retirement. They may have, had a 9 to 5, then retired, then bought apartment buildings, then retired from that, and then bought self-storage buildings, and now they're retiring from that. They typically, the number one answer that they said that the reason they're selling to us is because they want to travel and they don't want to have to deal with any ongoing business operations. Now, that's all great and dandy. We're getting really good cap rates. Even to this day, we're buying things at 8% cap rate, or if we're buying at a lower cap rate, we're using really fantastic seller financing strategies or joint venture partnership strategies with the seller in order to kind of mitigate the increasing interest rate environment that we've been seeing here. But the problem with that strategy is when you try to accumulate net rentable square footage. So unlike in the apartment space where you typically measure the size of your portfolio is based on number of units, that is not really feasible in the storage space, because you can have a unit that's 5 by 5, so 25 square feet, or you can have a unit that's a 10 by 30, which is 300 square feet. So to talk in unit numbers doesn't make a lot of sense. So we talk in net rentable square footage. Anytime I went above, call it 40 to 50,000 net rentable square feet, which would equate to, maybe 300 units on an average type of facility, immediately the cap rates halved. They went from 8s to 4s. And I was like, why is this happening? And then when I started talking to the sellers and talking to the brokers that we were dealing with, which is just pretty rare because we do most of our stuff off market, what I was realizing is all of a sudden now I'm competing with real estate investment trusts, publicly traded entities that have effectively unlimited capital at much lower costs of capital than what I have. So say an extra space that can go get a debt warehouse facility at, call it 2 point something. And then they can go out into Europe and raise $500 million in equity with a 0.875% bond. So less than 1% on their equity slice. Their combined cost of capital is like in the 2 range. So if they buy a 4 cap, they're automatically doubling their money. Where my cost of capital is much higher. Typically my investors, we're telling them that they're going to get between 18 to 22% internal rate of return. And then my debt in the past was, in the 4 to 5% range. And nowadays, March 2023, we're paying 6.5 to 8% on our debt. So our combined cost of capital is much higher. So how did we get around this? Well, this is when we created our second avenue of how we do self-storage deals. And that's to just build them ourselves instead of buying them and paying this premium to the developer. So we started building Class A institutional grade REIT facilities, basically. These are 3+ stories tall, state-of-the-art technology and security, has all the amenities and services a modern storage user would want. And these things are pretty large, anywhere between 80 to 110,000 net rentable square feet. So that was really great. And now we're able to build and start to really buff up our portfolio from a net rentable square footage standpoint. But then this is when the third avenue that we employ now came into effect. COVID hit, the pandemic hit. And specifically, we started to have insane volatility in materials pricing, as well as supply chain issues, where some things, regardless of what we were willing to pay, we just couldn't get it to the site in time. So how we mitigated this strategy then was we realized that big box retail stores like Sears and Best Buy and Kmart's and Walmart's were starting to go out of business. And we were buying up the shells of those buildings and actually converting them into Class A climate controlled storage. So nowadays, to long answer to your short question, we have 3 main strategies. The first is to buy from mom and pop facilities, aggregate them into larger portfolios of 10 to 20 properties each, and then sell them off in the market or refinance them in, the middle markets, perm debt type area. We have our ground up construction. So buy land and then build these 100,000 square foot facilities. And then we also have our adaptive use conversion funnel, which allows us to build roughly the same size facilities, but at 2/3 the cost and 2/3 the time of the construction to get to certificate of occupancy.
And Fernando, I'm all ears, man. This is really, really, really cool stuff. Seriously, I'm enjoying this conversation. I have a million questions. I don't even know where to start, but
let's go.
Yeah, I'm going to fire some stuff off. So how do you choose, how do you pick a location, right? I'm sure that there's some research that goes into it. Maybe you could just give us some kind of tips.
Yeah. So it all depends on which of those 3 funnels we're targeting, right? So if it's the mom and pop funnel, the location is not as important to me as far as am I in a top 25 MSA or I'm not? Because those deals where I'm getting the really good cap rates, I'm buying them in secondary and tertiary markets. So I may go buy in, Columbus or Des Moines, Iowa, or, even some unheard of areas like, Albertville, Alabama, or Liberal, Kansas, just because there's cash flow there and I can typically get a really good deal off market or seller financing. For example, today, we just locked up a contract on our seller finance deal where we're putting 12.5% down, 5% interest, 8-year balloon on a 30-year amortization. And the first year is all interest only. So there's still a lot of opportunities to do deals out there, even if you don't have to go the traditional bank route. Now, the more risky side and where you really have to focus on where to go is with these large Class A ground up developments, because the mom and pop stuff, I'm typically buying these things for $1 million to $3 million roughly. So I don't have to raise a lot of capital. Some cases I raise as small as $200K. And on the larger ones, we're raising maybe $1 million. If it's a purchase and expansion deal where we buy it and then we increase the facility by, 30% or 50% in size. The Class A stuff, though, because they're so large and the debt service in today's interest rates is so high, I'm paying close to, on a $16 million project, I'm paying close to $100,000 a month in interest. You really have to make sure that your underwriting is ironclad. So this is where I typically like to go. Primary markets, but not downtown, right? So instead of buying in downtown Charlotte, North Carolina, I'm going into a suburb or an exurb, as I would call it, which is between a suburb and rural, right? There, in one direction, you see a bunch of homes that have just been built by J.R. Horton. In another direction, you see a farm that is up for sale for a developer to buy. Those are perfect areas for self-storage because the lease up is much slower than multifamily. Typically when I build a 100,000 square foot facility, I'm assuming as a very conservative number about for my underwriting purposes at 2.5% lease up per month. In reality, we're hitting 3.5 to 5%, but I'm not going to show that to the bank. I'm not going to show that to the investors because I want to make sure I give myself enough buffer. So just using those numbers alone, that means it can take anywhere between 3 to 5 years for this asset to reach full stabilization and for you to refinance out of your construction to perm debt into more of a conduit style loan with CMBS or a life insurance company. So because of that, that's why these locations are really good, because you buy when there's a little bit of land between you and the areas that are being built up. So your land cost is really low. And then by the time you're stabilized, you're completely landlocked by houses that have a brand new construction with people that have really good median incomes, things like that. Another piece of why I love to build self-storage is because the cost to build versus the rental rate per square foot is insanely different than multifamily. So I'm still being able to charge roughly around the same amount of rent per square foot. But instead of me spending $400 to $450 a foot to build, I'm spending like $120 a foot to build these things. And that's all in costs. That's, hard costs, soft costs, interest and operating reserve for 4 years, financing and acquisition costs. I mean, that's everything, developer fees included in that. So that's my total net project costs is about like $120 a foot. So those are the areas that we're looking for as those primary markets, top 50 MSAs. We're doing a lot of stuff in the Tampa, Orlando corridor, Atlanta, Georgia, Charlotte, North Carolina. So those type of high growth, high job population or high job growth areas.
And this is great stuff, Fernando. So what is leasing? Well, let me backtrack a minute because you mentioned something about like state-of-the-art facilities. What would a state-of-the-art facility look like in the storage space?
Yeah, it's really interesting. So these facilities, they don't, when I go to a zoning board meeting for a municipality and I'm trying to get zoning changed to storage from whatever it is, the picture in their mind when I say self-storage are these, hinky metal buildings that are long rows with garage doors and gravel on the ground. They don't look very pretty. That's not what we built. The state-of-the-art facilities we build, they look like 3-story office buildings. They're absolutely beautiful, glass, great ornate work on the outside. And the state-of-the-art technology that we have in them, it goes from everything from keypad entry and exit, that each tenant has an individual code so I can track you moving throughout my facility. There's heat sensors in each one of the units that make sure that, God forbid somebody has a stroke or a heart attack in one of their units and nobody notices, we can pick up, there's a signature of body in that unit. You can unlock the door to the facility. You can unlock the door to your unit with your cell phone. There's cameras everywhere. And we even have the ability to run these facilities unmanned. So no need for a manager to be on site whatsoever. In addition to that, we have a lot of auxiliary profit centers and environmental kind of stewardship aspects that also help with the bottom line or the NOI. So for example, everything is run on electrical, even the heating, and then we hook up solar on the roof. Not only do we have solar on the roof, we also have battery storage on one of the less desirable units and electrical vehicle chargers outside to not only drive demand, but also to get a bunch of those tax credits that everyone's talking about nowadays. In addition to that, we have another option for additional revenue stream is to put 5G towers on our facilities. And that provides some really good revenue, anywhere between 100 to 300,000 NOI per year, depending on the density and the coverage of the existing carriers. So, I mean, these things, when you drive up to them, it looks like you're driving up to a really nice office building that CBRE would have an office in, or, one of these large Fortune 50 companies would, but it's just storage.
Man, that's awesome. What's a typical expense ratio?
So it depends on the smaller facilities, because you don't have the economy of scale. We're underwriting to about a 35 to 40% expense ratio. On these larger facilities where we do have economies of scale, we have the ability to leverage our systems. We're looking at stabilized expense ratios in the 28 to 32% range. So much lower expense ratio than what you typically see with, say, like habitation-based real estate or high utility cost real estate like data centers.
Yeah, sounds awesome. And what's the typical lease look like? Or are there leases?
So there are leases, but the nice thing about the leases based on the lien law across almost all 50 of the states in the United States is that, number one, all of our leases are month-to-month leases. And that's good because that allows us then to not only keep up with inflation faster, which is a hot button item here, because I don't have to wait for the end of the year contract, say in a multifamily facility, to raise rents. I can raise rents on a monthly basis. 2021 was the best year on record for us, where we had an average month over month increase in rent of 6.7%. So we finished out the year on some facilities between 75 and 100% increase in revenues, just from the ability to raise rents multiple times a year. The other piece that helps with that is obviously the auction component of it. It's a 30-day lease. And we give you notice within, 5 days of your late payment that we're overlocking your unit. So now you have no access to your materials and possessions until you pay us. And if you don't pay us, then we can auction off your possessions as fast as 45 days into the process. And along with that auction, we can charge things like a lien release fee, a lock cut fee, a cleaning fee. So not only are we not losing out on the additional revenue, we actually can completely get back to zero. So no longer being at a loss when we get a new tenant in there. The other piece that's really great about the lien law in almost all of the states in the United States is that these are automatically enforcing leases, which means, let's say I send you something egregious just because the market demands it. We've actually done this on a facility here a couple of weeks ago. We bought a facility that was 70% below market rents to the competitors. And in day one, we sent out an increase in rents of 65 or 67% above what the current tenants were paying. The crazy part is you don't have to agree to that lease. So you have the option of either getting out within that 30, 45 day time period of the new rent taking into effect, or the contract that we sent to you, regardless of if you signed it or not, automatically goes into effect, and I can use it in a court of law if you try to fight me against it.
I would assume, Fernando, that some people or many people have their like credit cards set up for automatic payment or something. Is that the case?
Yeah, and that's one of the value add propositions that we use when we're buying kind of these small mom and pop facilities. As soon as somebody sets it on auto pay, debit or credit or ACH transfer, man, they become basically a lifetime tenant. I've had facilities where I purchased where we're telling the new tenants that we're the new owners, and here's where to say, send checks and money orders, et cetera. And if they have ACH, debit or credit set up, there's nothing that they have to do. And I've had guys call me and say, what are you talking about? I don't have a unit with you. It's like, actually, you do have a unit with us. You've had it for over 10 years and it's been on auto pay on credit the entire time. You're not behind. So, what do you want me to do? So one of the value adds that we do is we'll buy facilities that are all cash facilities, because typically these mom and pops, I'm not going to sugarcoat it, they're committing tax fraud, right? So they're collecting all their rents in cash. They're not reporting the majority of what they're collecting, so they don't have to pay a bunch of taxes. But then the problem is when they go to sell, if it's anyone is buying with a loan, the lender is not going to go off of their stated collections. They're going to go off of what they can prove on 3 years worth of tax returns. So we end up buying these at substantial deals and then immediately implementing a policy where everyone has to get into auto payment as soon as possible. And if you don't, that's fine, but it's just going to be way more cumbersome and you're actually going to incur fees. So we'll say, hey, your new rent goes from $30 to $60 a month. However, if you set it up as a ACH or a debit or credit card auto payment, we'll give you a discount. We'll bump that down to 55 or 50, knowing that the market rate is 50. and we'll say, hey, everyone's at 60 unless you go to auto payment, and then you're at 50 and now you're at market rate. And if you don't like that, then you can move out, because in the end of the day, we don't want tenants that pay in cash because it's dangerous for our managers, to potentially get robbed. We don't want people that pay in checks because those checks can bounce. They can get lost in the mail. So we disincentivize the ability to pay with anything other than credit, debit, or ACH transfer. And then people say, well, what if they don't have bank accounts, or, what if they're an unbanked person? We also have programs that at no cost that help people with that. So they can go take their cash or money order to a 7-Eleven or a Walmart, depending on what part of the United States it's in. And they will actually send us an auto payment and collect the cash on our behalf for a small fee that we end up paying. So that's one of the biggest value adds that we have, because now we bought based off of reported income, which wasn't the real income, very understated. And then when we go to sell, not only have we increased revenue and dropped expenses, but we're reporting 100% of our income. And so when a new lender comes to, help our buyer buy our facility, they have full numbers on our tax returns.
Awesome, man. I have so many questions still. Do you guys do cost segregation studies and all that jazz?
100%. We absolutely love cost segregation studies. So at Self Storage Syndicated Equities, we have a motto where we're here to provide investors self-storage investments that are tax advantaged, that have downside mitigation first and foremost, and it also has a social stewardship component. So that tax piece is, number one, applying all of the cost segregation and bonus depreciation to our investors, and us as the general partners taking none of that in order to kind of juice the investors' tax benefits. On some of our deals, every dollar you invest, you get $2 back in the first year of operations in bonus depreciation. Another thing that we also do is, we also structure the losses so that all the losses, if it's a ground up development, if let's say all those losses from negative operations until we break even also get sent over to you as kind of ghost losses for you to write off against your other passive income. And then the third piece, which we recently started doing, which I really love, is we actually got our cost segregation engineers involved on the front end of the process. So they actually sit down and they meet with our architect and they say, architect, we love the plan that you sent over. However, we think that if you can change some of these components to make these movable walls or things that would qualify for the 5, 7, or 15-year tax bracket as opposed to the 39-year tax bracket, this would be a great service to your customer. And so now we have our architect and our cost engineer working together in order for us to build these things to be as efficient with the cost segs as possible.
Beautiful, man. Man, you're crushing it. Okay. What's the tip, before I forget this question, what's the typical length of rent, I guess, or length of stay for a tenant?
Yeah. So 25% of tenants stay between 1 and 2 years. Another 30% stay 2 years or longer based on the most recent study that came out in 2021. So you actually do have a much longer stay than what most people realize. Yes, these are monthly contracts. And yes, there are the people that, say, for example, they're going home from college for the summer and they only need a unit for 3 to 4 months. Or maybe it's someone that, is deploying on, military, and they need the unit for 6 to 9 or 12 months or 24 months. But the majority of the people that get into our facility, especially because of the way that we price things and how we set up our payment plans, they end up staying much longer than, say, a typical multifamily or single family resident that would stay, just because of the sticky factor. So here's an example that I love to use in the, multifamily versus single family space. So let's say you have a $150 unit that you're paying for. Let's call it a 10 by 10 facility. And I want to raise the rents by 13%. That's only a $20 increase. So that $20 increase a month on that $150 unit is usually not worth the $500 plus in cost to rent a U-Haul, spend a day off work to, unload your unit, go to another facility that may be, $5 cheaper. It just doesn't make sense. But now let's take that same 13% increase and apply it to, say, your average rental property. I increased a $1,500 per month rent by 13%, that's a $200 increase in rents. Most tenants will not stay if all of a sudden the rent increased by $200. What they most likely will do is start shopping for a new place to stay. And because of the way that the leases are written, you typically have to give your tenant, a couple months notice that you're going to increase their rents just so it doesn't mess up your operations, and you can clean the unit and show it and pay a real estate agent to get it rented for you. And the other piece is the trade area, right? So a storage user, they're typically, 65 to 90% of your storage unit users are within a 5 to 15 minute drive time of your facility or of where they live or work. So there's not a lot of other options they can go to. So if you're making sure that you're pricing according to the market and you're looking at your competitors, make sure they're not, doing anything crazy, they usually don't have as many options when you raise rents. Whereas say someone that's a multifamily renter, if you raise their rent by something they can't really stand, they're usually willing to go way farther away to set up, a new household. For example, I lived in Chicago for a long time, and I've stayed in almost, each major section of the city. I've stayed in the Northwest. I've stayed 45 minutes away in the south part of the city. I've stayed in the west part of the city. I've stayed on the north part of the city by Wrigley Field. So I'm willing to move very easily anywhere in the city. So all of a sudden now you have way more competition from other multifamily providers if, say, the rent goes up by $200 a month.
Yeah, Fernando. Wow. All right. I have one last question before I get to my final question. I know we're running out of time, but I want to provide this answer to my listeners, and I'm very curious about it too. You mentioned auctions. How does the auction work?
Yeah, so it's not as fun and cool as it used to be and how it's portrayed on, Storage Wars anymore. Now, how the auction process works is it's really automated and it's all online. It's kind of like an eBay process. So what will happen is we'll have our manager cut the lock when someone is late, and we have officially given them a lien notice and a intent to auction notice. They'll open the unit, but they won't break the barrier, so to speak. So they won't actually enter the unit. But what they'll do is they'll take a picture from outside the unit, as many angles as they can get to show everything in there. They'll put those photos on an online self-storage auction site like storageauctions.com, for example. And then people will have, 1, 2, 3 weeks to whatever you set for them to bid on it. Whoever is the winning bidder, they actually have to send you a deposit in addition to what they auction. So let's say the winning bid's $500. $500 gets transferred to me. But in addition to that $500 is a $100 or $200 cleaning fee. That once you go remove all of the possessions within a lot of time, typically we allow 7 days, you have to clean everything, broom sweep. So if my manager comes to that unit and sees that, you picked all the good stuff, but you left trash bags and clothes that are ripped up on the floor, I also get to keep that $200 and cleaning fee on top of it. And then usually what my manager will do, especially at my facilities that are completely full, is once you coordinate with them that you're going to come pick up the auction possessions that you won, they'll coordinate the tenants on the wait list to come meet you at the same time. So you clean out the unit, and as you're cleaning out the unit and broom sweeping it, a new tenant will be ready waiting to store their possessions. So we don't even have one missed day of operations that unit is empty.
That is sick, man. Cool, Fernando. All right, let's do this. I want to get my final question, and then I want to get people some form of contacting you because I know that they're going to want to reach out and see what you're up to and just connect with you. So Let's do this. My final question is, let's imagine it was 100 years from now. You have great-great-grandchildren and they're super happy and they wanted to write a book about you. What would you want them to title this book?
I think the title that I would love the best would be The Lives He Touched. So one of the things about Self Storage Syndicated Equities, which is our investment platform, but then our self-storage brand is called Social Self-Storage because we have this social stewardship component, is that self-storage is a hyper-localized business. Like I said before, the majority of our tenants are coming from a 15-minute drive time, or which would roughly equate to about 3 to 5 mile radius from our facility. So we want to make sure that we're helping our local communities that are supporting us. So we do a lot of charitable work and philanthropic work in the local communities, whether it be, battered women's shelter or animal shelters, or, sometimes the local police departments have toy drives or back to school drives where we fill backpacks with, school supplies, things like that. And we've gotten such, heartfelt letters that have come back based on these kind of local outreach functions that we've had. And we always rely on our managers that are in the market, that are there every day, talking to the local customers, going to the Little League games, going to the events. And it really is great. It really feels good. And we know that we're helping the people that are helping us and supporting us. So I think that would be the name of the book that I would love to see on, my legacy.
Dude, I love it, man. That's awesome. Fernando, it has been an honor and a pleasure to talk to you today. I really, really, really learned so much. And if I had the time, I'd be hanging out with you even more here tonight. But let's get the listeners some form of contacting you.
Yeah, so I'm a big fan of the book Atomic Habits. And the more barriers you put in front of somebody, the less likely they are to do something. So when it comes to contact, I don't like the whole go check out my social media, which is, Self Storage Syndicated Equities or the Storage Stud, or go to my website that has a fill-in form, which is ssse.com. Here's the easiest way to contact me. I'm going to give you my personal cell phone number. This is my real cell phone number. If you text me, if you call me, I'll get right back to you. It's area code 630-408-8090. 630-408-8090.
Beautiful, man. Hey, Fernando, again, I can't thank you enough for this conversation. Truly enlightening. And I am sold, man. I need to start investing with you or alongside of you. So yeah, I'm excited to get that analyzer and start moving with it, man. Thank you.
Yeah, absolutely. Talk to you soon.
Hey, Small Axe community. I would like to say thank you for listening to another episode of this podcast where we show you how to use your small axe to build a lasting empire. Now, if you like what you heard, it would mean the world to me if you could leave me a 5-star rating and write a written review. Hey, let's take it one step further and share this podcast with someone that you feel could benefit from it. And until the next episode, keep sharpening those axes.